So, Doyin, would you like to move on?
Thank you very much, Kashimana. Moving swiftly, we have international panelists in the person of Jeremy Dean. Jeremy, you had a couple of backgrounds to ship finance in Nigeria. You had a couple of issues that the ship owners have raised, the agency, and I know you worked in this client transactions and had a couple of events come into this waters. From your experience, can you please give us a brief overview of how foreign banks tend to categorize their desks and what do these desks really deal with? This is calling on something that and also, can you give us a typical ship financing cycle? I think it's important for our viewers to also understand what the cycle is. And we're hoping to touch upon what kind of tenors you typically use, the kind of vessels you normally finance, what you try to take on. And lastly, I'm sorry to put everything all together, is that what international banks or international non-banking lenders like Hayfin or leasing companies like ICBC look at before advancing ship financing facilities to borrowers from countries like Nigeria. And so we can learn from this for the benefit of people like Mr. Undu and other people listening. Thank you very much.
And thank you to the Nigerian Bar Association's Maritime Committee for inviting me to join the panel today. It's an honour for me to do so. Answering your first question, how do international banks categorise their desks and what do the desks deal with? In this context, it's important to remember that when we talk about shipping, we're primarily talking about tankers, dry bulk and container ships. Offshore would be specifically covering rigs and OSVs, whereas energy would be covering upstream E&P activities. And that energy business is usually in a separate business team. Some banks combine shipping and offshore, others run them in independent teams. It's fair to say that in shipping, banks generally want to avoid specialized assets. What you're looking for is liquidity, both in terms of asset deployment and in sale and purchase markets. In offshore, it's difficult to avoid specialization because of the nature of the asset. So what you try and do is differentiate by utility and specification. And there's probably a preference for higher end assets rather than the sort of more common everyday assets. However, it's probably fair to say that there's little appetite for offshore currently. The whole industry from rigs to OSVs in the international scene is facing another round of restructuring. Last time around in 2016, we had the benefit of legacy contracts to shelter the immediate impact of the downturn. We don't have that today, and what that means is that the market dynamics are suggesting that few will be rushing to increase offshore exposures. Now, in terms of the ship financing cycle, what I think is common, and I think Sir Peter touched on this, is that shipping finance actually reflects a mix of disciplines. It's some corporate lending, it's some asset finance, it's some cash flow lending, it's some project finance. And I think generally international lenders approach ship financing in a very systemic way. It's not that every deal is the same, but there is a process and procedure that tends to be followed. Now, clearly, the whole thing begins with an approach from the client or his advisor. And at this stage, what we, and both at Hayfin and in banks where I've been previously, you'd conduct high-level client due diligence, an initial review of the project and asset, and perhaps formulate high-level terms for the financing. Now, those terms would be informed by the cyclicality in shipping. And generally, one would say it's better for lenders to build exposure at times of market weakness in anticipation of improving conditions. You'd generally be more defensive in the way you structure a transaction if you believe the relevant sector is at or around its peak or heading towards a phase of contraction. Now, having done your initial review, you'd show the client high-level terms, and that would be an outline of the main commercial terms. And if that is accepted, you'd then do a much deeper dive on your due diligence with a view towards producing an investment memo for credit committee approval. What a clear trend has come out in the last 18 months, 2 years, is a focus for lenders on ESG issues, and I'm going to touch on that later. The credit committee paper is a significant document that might typically have 4 main parts. You'd analyse the projects, the parties involved, relevant contracts. It would detail the key terms of the financing. It would also analyse the asset, its place in its market. We'd be looking at current asset values and earnings compared to historic data. Clearly, we'd be expected to identify key risks and mitigants. And we would also, in our papers, have a detailed market and fleet analysis. The reason for that is that alternative lenders and leasing companies, and Hayfin is an alternative lender, we have far more of an asset focus and a market focus than we do a corporate balance sheet type focus. Now, in parallel with the credit work, we'd also draw up a very detailed term sheet that would form the basis upon which transaction documentation is to be drawn up. Now, that will commit the borrower to paying a work fee and funds on account of legal expenses before the lender's lawyers are instructed. And once we get through to the drafting of documentation, it's then we do full due diligence on the underlying insurance packages and have commissioned an independent advisor's report on those insurances. Then I guess that brings us towards financial close and disbursement of funds. And one of the key things here is that we need to make sure we know to whom we're paying money and control that process. Now, that may be with paying money to the yard in case of a new building. It may be that we're paying the outgoing bank in case of a refinancing. But the key thing is, whatever you're doing, you make sure funds are released only when your vessel mortgage is in place. But once you get to that point, that's not the end, because there will always be ongoing monitoring over the life of the facility. Now, this involves regular client contact to ensure the project is proceeding to plan. We want to ensure that vessel cash flows are dealt with as set out in the facility documentation. There'll be regular financial reporting from the client to us. There'll be asset monitoring in terms of tracking and vessel inspections. There may be work in connection with renewal of insurances and relevant certifications, including class. Now, all those things will be followed by international lenders. And even at maturity, we stay involved, because we're obviously not going to release our collateral unless we can be certain the loan is fully discharged. Now, within this process, there's no doubt there has been a trend towards reducing the tenor of the facility. 5 years is the norm, but it's the repayment profile that is much more important. Now, in shipping and for high-end offshore assets, banks typically lend against profiles that amortize the vessel age of 12 to 15 years. Amongst the alternative lenders and lessors, we're looking at profiles that go to vessel age of 15 to 18 years, because it's all about matching debt repayment to the cash flow generating capability of the underlying asset. And that, from what I've heard, that seems to be one of the issues that's faced within the context of ship finance in Nigeria today. Now, you asked I talk about security packages. Now, transaction documentation has become more complex, but the underlying security package has essentially remained the same. Lenders look at constructing ring-fenced corporate structures so that we have a specific silo in which the vessels we are to finance will be housed. And our security comprises essentially the vessel mortgages, cross guarantees from corporate entities in that ring-fence group, share pledges, including one that would give us a single point of enforcement, assignments of earnings and insurances, and also pledges over relevant collateral accounts. So this might be the earnings account, which receives the contracted revenue or the earnings generated by the ship, what we call the minimum liquidity account, and also the dry dock reserve account. We might also use covenants to protect ourselves, and this could either be in the form of dividend restrictions, cash traps, or cash sweeps to operate at times of excess earnings when we can increase the rate of our amortization. I would say it is extremely rare for personal guarantees or pledges over personal assets to be a feature of international ship financing transactions. Generally, it's much more done on a corporate basis. Now, the approach that we would have is the same whatever the jurisdiction of the borrower or the project. Now, we, Hayfin, non-bank lenders such as Hayfin and leasing companies, focus essentially on the client, the asset, and its market. We don't spend hours poring over balance sheets and accounts. Now, when we're talking about the asset, we'll be thinking about the builder, the age, the ship specification. Are there things about it that make it unique or less attractive? Its condition. We'll be thinking about who is going to be the technical manager, what's the plan to maintain the vessel and keep her in class. We'll be thinking about the vessel's alternate use and liquidity. In terms of the market, we'll be thinking about where are we in the cycle, the shipping cycle. What do we think the trajectory for vessel asset values and earnings will be? And all of this will feed into what we call our break-even analysis, where we look at the earnings needed to service first operating costs, then operating costs plus principal interest, and then finally operating costs plus full debt service. We also look specifically at the asset values that will be needed to cover our balloon due at maturity, because indirectly we are taking market risk at that point in time. Now, the client is of fundamental importance. We'll be looking at the client's track record and reputation, also their ability to provide liquidity to the structure if that is needed. And as I said earlier, we also now have a major focus on ESG. Now, just touching on some of the things that we specifically talk to our clients about in this context. In the environmental context, we're looking at class compliance, we're looking at port state control detention history, we're looking at the plan to comply with IMO 2020, we're looking at their insurance track record. Under the social headline, we'll be looking at the compliance with Maritime Labour Convention, the ISPS and ISM codes, health and safety policies, staff training, relevant CSR activities. And when we come to governance, even for privately owned companies, we'll be looking at corporate structure, governance policies. This may be a code of business conduct, remuneration policies, board composition, and importantly today, sanctions compliance. Now, in short, there's a huge amount of work that gets done from the initial approach to disbursement, but you don't invest or lend money without thorough due diligence. And then you monitor closely to ensure that the project is proceeding to plan and in compliance with the loan terms.
Yeah, thanks very much for very detailed response to that question. Touching on briefly on what Mr. Undu said, do you see opportunities for leveraging on availability of the fund, the amount of funds available to leveraging it? So, for example, we know the Capital Vessel Financing Fund has about 200 to 250. The local content fund, which is closely related to this, is also doing about 200. Is there opportunities to leverage that 200 to something much more, to a guarantee amount of about 1 billion? And how do you think maybe that may be achieved? I apologize for speaking on the spot, but just your opinion to be, your advice to be appreciated. Thank you.
Okay. Others are far more familiar with the local financing scene and the environment in which that must operate. But one of the things that I thought is that there's always issues around ensuring government bodies get value for money when they are providing support to any industry. And it's also important that the industry doesn't think that this is free money, because all that does is encourage inefficiency. Now, one of the things that hearing the discussion earlier, yes, the idea of using guarantees to leverage those funds may help, but I think it's important that the funds be made available in as broad a way as possible. And one additional way of doing that may be perhaps for whether or not it's possible to use those funds to, I'm going to use the phrase, co-invest alongside the ship owner's equity. Now, when I use the phrase co-invest, I'm not suggesting that needs to be by way of common equity, preferred equity, or some form of junior loan. That's a point of detail to be worked out. But if it means that the overall equity pool can be increased, I think it was just mentioned that Nigerian ship owners should be given the name highly indebted persons. But you know, if you can actually stretch that pool of equity resource, then the required leverage from the banks will reduce, which may make it easier for banks to come to the ship financing market. And then that may be one way of actually ensuring that, as the DG said, you actually get circulation of monies, because if you're there as co-investor, the idea is those funds do come back to you and then can be redeployed in future again. So that there's a suggestion, but I'm not the expert to talk to you around solving this particular problem in Nigeria.
Thank you very much for your response. Kashima, over to you.